Borrowed money is not income. That sentence is the entire mechanism. The reason Elon Musk paid 0 in federal income taxes in 2018. The reason Jeff Bezos paid 0 in 2007 and again in 2011. And the reason this strategy is not reserved for billionaires, but is available to anyone with a $250,000 taxable brokerage account and enough patience to hold their assets. The ProPublica investigation in 2021, using actual IRS data that had never been made public, found that the top 25 wealthiest Americans grew their combined wealth by $401 billion between 2014 and 2018 and paid $13.6 billion in taxes, and an effective rate of 3.4%. Warren Buffett's true tax rate on approximately $24 billion in wealth gains over that same period was 0.1%, not 1, 0.1. And the mechanism is not offshore accounts, not fake charities, not an army of tax attorneys in a conference room. It is 3 steps in the tax code since 1921. And the part almost everyone misses is that it doesn't just defer capital gains taxes, it eliminates them permanently, legally. The IRS didn't miss this. They wrote the rules. This strategy has a name: buy, borrow, die. Which sounds like a headline from a publication that's mildly upset about rich people, but it's actually a description of 3 steps. You buy appreciating assets, index funds, real estate, business equity. You borrow against those assets instead of selling them, because borrowed money is not taxable income, and income is what the IRS taxes. And when you die, a provision called the stepped-up basis resets the cost of those assets to their value on the day you died, which means every dollar of capital gains that accumulated over your entire lifetime of investing is permanently removed from the tax calculation. Your heirs inherit as if they bought everything yesterday at current market prices. The gains that were never triggered during your lifetime, gone from the IRS's perspective. Not deferred to the estate, not shifted to heirs, erased. I want to show you how that mechanic actually works, what the math looks like in real dollar amounts, and what an accessible version of this strategy looks like for someone who is not running a family office. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. They use average returns instead of sequence of returns modeling, which is how real portfolios actually fail. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Here's the mental model I want you to carry through this video. Think of your investment portfolio as an escalator. It goes up, not in a straight line. Sometimes it drops hard, sometimes it stalls for years, sometimes it overshoots, but over long periods, it goes up. When you need cash from that portfolio, you have 2 options. Option 1, take the emergency exit staircase, step off the escalator, sell your assets, collect the gains, hand the IRS 20 to 24% of everything above your cost basis, and now you're standing at the bottom of the building with less money than you expected and no position remaining on the escalator. The assets you sold stopped compounding the moment you hit sell. Option 2, stay on the escalator, borrow against the portfolio. The bank hands you actual spendable cash. Your assets stay in place, fully invested, continuing to rise. You owe interest, and in most cases, that interest is less than what a diversified portfolio earns in a year. The loan is not income, nothing was sold, the IRS sees nothing because there is nothing to see. You stayed on the escalator, and someone handed you a check for the privilege of riding it. That is the whole concept. Stay on the escalator. Every time something sounds complicated in this video, that phrase is what it's describing. And the reason most people have never heard of this is not that it's secret, it's that every major financial publication frames it as a billionaire strategy, which trains regular people to file it under not applicable and close the tab. That reflex is expensive. In a few minutes, I'm going to show you the specific provision in the tax code that transforms this from a smart deferral into a permanent elimination, something that survived over a century of reform attempts, including a direct assault from the Biden administration in 2021. But first, let me make the arithmetic concrete, because most people have heard borrow instead of sell and think they've processed the idea. They've heard the concept, They haven't run the actual numbers. Say you bought $100,000 in a broad S&P 500 index fund 15 years ago, around 2011. By early 2026, you're looking at roughly $400,000 to $450,000 in market value. Your cost basis is still $100,000. You have $300,000 to $350,000 in unrealized capital gains sitting there, untouched, silently compounding. You need $250,000. Rental property, down payment, business investment, buyout, doesn't matter. 2 choices. Choice 1, sell $250,000 of the fund. Since roughly 80% of the current value represents gains over your original cost, you're realizing about $200,000 in capital gains. Federal long-term capital gains rate at the top bracket, 20%, plus the 3.8% net investment income surtax for higher earners. Combined federal rate, 23.8%. That is $47,600 in federal taxes before states enter the picture. You net roughly $202,000 after the federal hit. The $250,000 in assets you sold are off the escalator, not compounding. Done. Choice 2, set up a pledged asset line. I'll explain what that is properly in a few minutes, and borrow $250,000 secured by your portfolio. At rates prevailing in early 2026, roughly 6 to 7% annually, your annual interest cost $15,000 to $17,500. Your portfolio stays fully invested. At the historical long-run average of 7% per year, a $450,000 portfolio generates approximately $31,500 in annual growth. Net of interest, you are positive. You have $250,000 in your hand. Capital gains tax paid, 0. The gap between those 2 choices is $47,600 in taxes. Paid once, but compounded forward at 7% over 20 years, that becomes approximately $170,000 in wealth you will never have. That is the actual cost of the emergency exit staircase. It doesn't feel expensive when you're paying it. It feels expensive 20 years later when you check the math and realize what you left behind. There's a parable I come back to often. 2 neighboring farmers in Kansas in the 1930s. Both start with 1,000 acres of prime land. Every time the first farmer needs cash, a drought year, a medical bill, new equipment he sells, acreage, 20 acres here, 50 acres there, always at fair market value, always the obvious, sensible move. By the time he dies, his estate has 60 acres left. His neighbor, same starting position, same pressures, same era, never sells a single acre. He borrows against the land every time he needs liquidity. Local bank, tight repayment schedules, some uncomfortable years. Dies owning the full 1,000 acres. His family has farmed it for 4 generations. That land is now worth 30 to 40 times what either farmer started with. The first farmer was not stupid. He was intuitive. And intuition, when applied to appreciating assets, is almost always the expensive choice. Now here's what nobody explains properly. This is where the strategy stops being useful and starts being extraordinary. What I just described is technically still a deferral. You borrow $250,000. You still owe it plus interest. Something eventually resolves the loan, you sell assets to pay it back, you roll it over, or you die. And when you die, Section 1014 of the Internal Revenue Code does something I find remarkable every time I explain it. When your state passes assets to your heirs, the cost basis of those assets is stepped up, reset to their fair market value on the date of your death, not what you originally paid. The current market price on the day you died. Which means every dollar of capital gains that accumulated in your portfolio over your lifetime and was never triggered by a sale is permanently removed from the tax calculation. Your heirs inherit as if they bought the assets yesterday at today's prices. If they sell immediately, the gain is mathematically 0. The IRS has no claim. You might think this is a deferral. It is not. It is a permanent elimination, but only if you hold the assets until death rather than liquidating during your lifetime. That single distinction changes the entire nature of the strategy. Here it is in numbers. You spend 30 years building a portfolio worth $2 million. Your total original investment, everything you actually paid across 3 decades, was $200,000. You are sitting on $1.8 million in unrealized capital gains. During your lifetime, you borrowed against the portfolio multiple times. Home renovation, a business investment, your kids' education. At the time of your death, you have $500,000 in outstanding loans secured by the portfolio. Your estate sells the $2 million portfolio, pays off the loan, your heirs receive $1.5 million in cash. Here's what the IRS collects: nothing. The stepped-up basis means those assets were sold at market value, with a cost basis equal to market value. The gain is zero. $1.8 million in lifetime capital gains permanently erased, legally. The IRS has no claim on it because, from a tax code standpoint, the gain simply ceased to exist at the moment of death. Run the alternative. You sold the portfolio during your lifetime to pay off the loan. Same proceeds, same payoff. You owe approximately $428,000 in federal capital gains taxes on that $1.8 million in gains. $428,000 that Section 1014 instead delivers to your family, not to the Treasury, to your family, for holding instead of selling, for staying on the escalator. Stay with me, because this next part changes everything. The Biden administration tried to kill Section 1014 in 2021. The American Families Plan proposed treating death as a taxable recognition event, forcing realization of gains above $1 million at the moment of death, eliminating the step-up in basis. It failed. It came back in modified forms. It failed again. Similar proposals have been introduced and defeated going back to the 1970s, protected by a coalition that runs from billionaires to family farmers to small business owners, who would face catastrophic forced liquidations to pay taxes on operations they never intended to sell. That coalition has held for over a century, but it has never been guaranteed, and it isn't now. Every administration that touches tax reform takes a swing at this provision. None have landed yet. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Because what comes next is where this goes from theory to something you can actually use this year. A financial advisor I know explains buy, borrow, die to new clients. 9 out of 10 say, that sounds illegal. He says, I know, but so does paying $47,000 in taxes to access your own money, and that one is definitely legal. In a few minutes, I'm gonna show you what catastrophically wrong looks like with this strategy and 3 specific rules that separate people who use it correctly from the ones who blow up. But first, here's the framing error that costs most people their shot at using this in the first place. Every time buy, borrow, die gets covered in mainstream financial media, Bloomberg, Wall Street Journal, Forbes, the framing is always billionaires, Bezos, Musk, the Walton family. And because the framing is always billionaires, normal people mentally categorize it as someone else's problem. That is a costly reflex. The mechanics scale down. There are 3 levels at which you can access this strategy depending on where you are financially right now. The first level is margin loans. If you have a taxable brokerage account anywhere, Fidelity, Schwab, Interactive Brokers, you already have access to margin lending today. Regulation T allows borrowing up to 50% of eligible portfolio value. Interactive Brokers runs margin rates in the 4 to 5% range on larger balances in early 2026. Schwab and Fidelity charge more. Margin is the most accessible version of this strategy and the most prone to going badly for a specific structural reason I will explain shortly. It requires more discipline than most people apply, not less. The second level is what the wealthy actually use: pledged asset lines, also called securities-backed lines of credit, offered by the wealth management divisions of major banks, Merrill Lynch, Morgan Stanley, JP Morgan, most regional private banks. Minimum collateral typically starts around $250,000 to $500,000 in eligible assets. The interest rate is a spread over SOFR, generally competitive with mortgage rates in most environments. The key structural difference: pledged asset lines are separate credit facilities, not securities accounts. The forced liquidation triggers are more forgiving, and the lender has more discretion during a market drawdown. In a volatile stretch, That separation is the difference between riding it out and being sold out at the worst possible moment. The third level you may already have and have never thought about this way: home equity. A home equity line of credit is at its core borrowing against an appreciating asset. The stepped up basis applies to real estate at death as well, with some state level nuances, and the core logic is identical. Hold the asset, borrow against it. Delay or eliminate the realization event. I personally have multiple hundreds of thousands of dollars invested across taxable accounts, and my order of operations is home equity first for large capital needs, pledged asset line second, margin as a last resort, and only with adequate downside protection. Now, I want to introduce someone. His name is Marcus, 47 years old, software engineer in Austin, disciplined investor for 20 years. In early 2022, he had $400,000 in Apple stock accumulated through his company's employee stock purchase plan. He needed $300,000 for a down payment on a rental property in Phoenix. His financial advisor and I used that phrase with the warmth of someone who has met many financial advisors, told him to sell enough Apple to cover the down payment. Marcus had never heard of a pledged asset line. He sold $300,000 in Apple in March 2022. Cost basis on those shares, roughly $60,000. Capital gain, $240,000. Combined federal and Arizona state taxes, approximately $58,000. He funded the down payment. The rental property has since appreciated. By surface metrics, Marcus is fine. But Apple, since early 2022, is up roughly 80%. Those shares will be worth approximately $540,000 today. Marcus paid $58,000 in taxes for the right to not own $540,000 in Apple stock. We are going to come back to Marcus. Before I show you what doing this correctly looks like in numbers, and walk through a case where someone saved over $26,000 in taxes on a single transaction, let me show you what it looks like when this goes catastrophically wrong. Because the catch is real. In March 2021, Bill Huang's family office, Archegos Capital Management, imploded. The structure: large, concentrated positions in a handful of stocks, borrowed against at extreme leverage through total return swaps, in some cases 4 to 5 times the underlying collateral. For years, it generated extraordinary returns. Then several positions dropped sharply over a short period. The leverage turned modest percentage losses into catastrophic negative equity. Brokers issued margin calls. Forced liquidations began into an already declining market, which pushed prices further down, which triggered more calls from other brokers. Roughly $20 billion in positions were liquidated in days. Banks took massive losses. The legal and tax aftermath is still playing out in courts. Same mechanic as buy, borrow, die, different discipline. Specifically, none. 3 rules. That's what separates this from becoming your story. First, borrow only against diversified portfolios. If any single position represents more than 40% of your investable net worth, you do not run this strategy until you diversify. A broad index fund portfolio is structurally resistant to the concentrated single name collapse that destroyed Archegos. Second, keep your loan to value ratio at or below 30%. If your portfolio is worth $600,000, your outstanding borrowing stays under $180,000, not the 50% margin allows, not the 60 or 70% a pledged asset line technically offers. At 30% LTV, a diversified portfolio must fall more than 50% before you're near a margin call. That level of drawdown has not occurred in a diversified index fund portfolio since the 1930s. Third, cover the interest from earned income outside the portfolio. Your salary, your business income, your rental income, something outside covers the payments every year regardless of market conditions. You never want a down year to force a sale to service debt. That is how a temporary drawdown becomes a permanent loss. Here's what it looks like when you do it right. Jason is 52, a dentist in Portland, $600,000 diversified portfolio, 60% US total market index fund, 30% international, 10% short-term bonds. Aggregate cost basis, $150,000. He needs $150,000 to buy out a retiring partner in his practice. Under the 30% LTV rule, his safe borrowing ceiling is $180,000. He sets up a pledged asset line at his private bank, borrows $150,000 at 6.2%. Annual interest, $9,300. Portfolio's expected annual growth at the long-run average of 7%, roughly $42,000. He is net positive $32,700 per year after covering interest. The full $600,000 portfolio stays invested, fully intact, compounding. His heirs will eventually inherit the entire portfolio, whatever it has grown to, with a stepped-up basis on all $450,000 in accumulated gains. The IRS collects nothing on those gains. Jason stayed on the escalator. Jason's alternative: sell $150,000 of the portfolio, realize about $112,500 in capital gains, pay roughly $26,000 in federal taxes. That $26,000, compounded at 7% for 25 years, is approximately $137,000 his family will never see. For a loan he could have serviced at under $10,000 a year from his dental practice income. The emergency exit staircase does not look expensive when you're standing in front of it. The bill arrives over decades in the compound interest you never earned. The phrase buy, borrow, die apparently tested poorly with financial services focus groups because the die part makes advisors uncomfortable. Their preferred internal term is apparently strategic asset-backed liquidity management. I verified this. Some of them actually use it. Same mechanism, different anxiety level about the last word. Let's close the loop on Marcus. He sold the Apple in 2022, paid $58,000 in taxes, and watched the remaining position keep climbing. Here is what he should have done. $400,000 in Apple, set up a pledged asset line, borrow the $300,000 down payment at roughly 6%, approximately $18,000 per year in interest. Over 5 years, roughly $90,000 in total interest cost. He would own the rental property. He would still hold the $400,000 in Apple stock now, worth approximately $540,000. Net position today: a performing rental asset, a $540,000 equity position, a fully satisfied loan. Versus what actually happened: the rental property, a depleted portfolio, $58,000 paid to the IRS that is gone forever, and the permanent ghost of $320,000 in Apple upside that left the building in March 2022 and never came back. Marcus told me the number that actually keeps him up is not the tax bill. It is the compounding he lost, and that is exactly the psychological trap this strategy is designed to avoid. People treat taxes as a one-time event. They are not. Every dollar you pay in taxes today is every future dollar that dollar would have generated, compounded forward indefinitely. The tax is not what you pay. The tax is what stops growing. Most financial mistakes are not math problems. They are brain problems. The hardest one to fix is the reflex that makes selling feel responsible and holding feel like you are being clever. 3 things to take from this. First, the next time you need liquidity from a taxable investment portfolio, price out a pledged asset line before you sell anything. Not sometimes, every time. Make it automatic. If the interest cost exceeds the tax savings on a fully honest comparison, sell, but run the comparison every single time. Second, calculate your current loan-to-value ratio on your taxable accounts. Know exactly how much you can safely borrow at 30% LTV. That number, sitting in your head, changes how you see your financial options in real time. It expands the menu. Third, read Section 1014 of the Internal Revenue Code. Know what the stepped-up basis does. Know that it has survived every legislative attempt to kill it for over a century. And know that every year you hold an appreciated position. Instead of selling it, you are moving a tax liability from your lifetime, where it costs real money to your estate, where it either legally disappears or becomes a problem on a much larger pile of assets than you have today. Lazy investing built more fortune than crypto memes. The IRS wrote those rules. Congress keeps them in place. You did not design this system. You are not obligated to pretend it does not exist.